Good morning, everyone, and welcome to another Mortgage Monday. Today, our topic of discussion is private mortgage insurance. Again, if anyone has any questions during the presentation, please feel free to chat your question or save it for the end for the Q&A after, and we'll stay around for a bit to just field your questions. So without further ado, let's begin. Private mortgage insurance. Private mortgage insurance, also known as PMI, is a type of mortgage insurance from private insurance companies used with conventional loans. PMI protects the lender if you stop making payments on your home loan. If you're required to pay private mortgage insurance, it typically makes up a portion of your monthly mortgage payment, in addition to your principal, interest, property tax, and homeowners insurance. Similar to the interest, property tax, and homeowners, payment of your PMI does not build equity in your home. So why do you need a PMI policy? Private mortgage insurance minimizes the risk for lenders to offer loans to borrowers who don't have a 20% down payment and therefore have less equity in their homes once they're purchased. This equity would help pay the loan balance in the event you default and go into foreclosure. Your lender requires you to have private mortgage insurance so that if you can no longer make the payments on your home, the lender will still get paid through the private insurance policy paying out. PMI basically safeguards the lender in the event of borrower default. It does not protect you, the borrower, if you fall behind on your mortgage payment. If you fall behind on your payments, your credit score could suffer, or you could lose your home through foreclosure. What are the different types of PMI? In general, there are two types of mortgage insurance. Mortgage insurance bought from the government, designed for those with FHA loans, or private mortgage insurance for conventional loans, which is bought from the private sector. Basically, the type of mortgage insurance required will depend on the type of mortgage loan you get. Who is required to have PMI? Typically, on a conventional loan, if your down payment is less than 20% of the value of the home, lenders will require you to carry private mortgage insurance. Usually you pay those mortgage insurance premiums until you have enough equity in your home to have the loan-to-value ratio, which is simply the amount of money you borrowed divided by the value of the property you bought, of 80%. For example, let's say you bought a home with a value of $100,000 and put a down payment of 10% or $10,000 and got a $90,000 loan to pay the rest. Your LTV, or loan to value, in this case would be 90,000 divided by 100,000, or 90%. The longer you pay down your mortgage, the lower your loan to value will become. On FHA loans, mortgage insurance is normally required regardless of the LTV. How much does mortgage insurance cost? Conventional mortgage insurance rates vary. Usually, the lower your down payment and/or the lower your credit score, the higher the premiums. The rate you receive for your private mortgage insurance will depend on your credit score, the amount of money you have for your down payment, and the insurer. But typically, the premiums for private mortgage insurance can range from $30 to $70 per month for every $100,000 you borrow. So if you bought a home with a value of $300,000, you might pay about $150 per month for private mortgage insurance. On FHA loans, there is an upfront MIP, or mortgage insurance premium, and an annual premium, which is collected monthly. When do you pay PMI premiums? When you're required to pay your private mortgage insurance premium depends on your specific loan policy. But typically, paying your mortgage insurance premiums is done monthly and happens right along with your mortgage payment for your current loan. You can just send one payment to the lender. Lenders may also have a policy that allows you to pay your PMI on a lump sum basis, either in cash or at closing, or finance the premium in your loan amount. How long do you need to have the mortgage insurance? You're typically required to pay a private mortgage insurance premium on a conventional loan for as many months or years it takes to build enough equity in your home to equal 20% of your home's value and have a loan-to-value ratio of 80%. For many homeowners with FHA loans, mortgage insurance is required for the life of the policy, which is up to 30 years. Can you avoid paying for mortgage insurance? Well, yes, if you put down 20% or more when you buy a home, you can avoid paying for private mortgage insurance on a conventional loan, not an FHA loan. Otherwise, there are a few loan options that do not require mortgage insurance. Some lenders offer lender-paid mortgage insurance, or LPMI, which is similar to borrower-paid PMI, except that it's paid by the lender and built into the interest rate of the mortgage. LPMI is usually a feature of loans that claim not to require mortgage insurance for high LTV loans. The advantage of LPMI is that the total monthly mortgage payment is often lower than a comparable loan with borrower-paid PMI. But because it's built into the interest rate, a borrower can't get rid of it when the equity position reaches 20% without refinancing it. Qualified veterans can apply for a VA loan that allows up to 100% financing. That's 0% down payment and does not require mortgage insurance. They may only require an upfront funding fee that certain veterans may be exempt from. Some lenders offer non-conforming and portfolio options that accept down payments as little as 5% and do not require PMI. So how can you remove private mortgage insurance? Once you've built up 20% equity in the house, either by the reduction to the loan balance through your monthly payments, or your home has appreciated in value due to market conditions and or home improvements you've made, private mortgage insurance usually may be canceled. The lender usually won't automatically cancel the PMI until you've reached 22% equity based on the original appraised value of the home, or unless you contact them to request cancellation at 20% of the current market value. So if you own a home with a value of $100,000 and you've paid it down to $20,000 in principal, you've paid down $20,000 in principal and you owe $80,000, you can request to cancel your PMI. Be sure to contact your lender once you've hit 20% equity. To stop paying your mortgage insurance policy on an FHA loan, you can refinance it to a conventional loan once you have enough equity in your home. Again, 20% equity is needed. You'll also want to make sure your credit score is high enough to qualify and that interest rates make financial sense for you. Okay, so that brings the presentation to an end on mortgage insurance. So stick around for some questions from everybody. Now's the time. Okay, no questions. So again, if anyone has any questions that come up, please email, text me, call me. And this cheat sheet can be used to issue to your borrowers if they have questions about that. I do issue it when I speak to people who need an explanation on mortgage insurance. And I hope this was a useful presentation for you. Thank you very much for joining. Aloha. Have a great day.